Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. A newspaper headline a few days ago said that direct tax collections, which is income tax collections in India, have surged by about 45% to touch 3.29 lakh crores as at 15th of June, as against 2.33 lakh crores during the same period last year. There has been a buoyancy in tax collections during this period, and the government thus sounded upbeat about it. The highlights of the tax collections up to 15th of June were that gross tax collections grew by about 40%, with corporate tax collections standing at 1.91 lakh crore rupees and personal tax collections touching a figure of 1.78 lakh crore rupees. The second, advanced tax collections for the June 22 quarter stood at 1.03 lakh crore rupees as against 75,783 crore rupees a year ago. And finally, tax refunds during this period amounted to rupees 30,334 crores. The government expects these figures to go up as it is yet to receive complete data from all tax collection centers in the country. The total tax collection, which is direct and indirect for the current financial year, is estimated at rupees 27.58 lakh crore rupees as per the budget estimates that were presented, as against rupees 25.16 lakh crore rupees during the financial year FY 2022, showing a growth of 9.6% in collections in tandem with the expected GDP growth this year. With growth estimates for the current financial year having been downgraded to 7%, it is unlikely that the government will be able to achieve these tax collection figures as were projected in the budget. The government responded to this tax collection report to say that these robust tax receipts further fortify the economic revival and that the improved tax collections were aided by a revival of economic activities and by better tax compliance too. Tax collections constitute the main revenue receipt of the government, and rising tax collections would mean a much needed improvement in the government finances. It would mean that the government has more money to spend, particularly on capital expenditure. It would also mean lesser borrowings for the government during the current year, and it would also mean a reduced fiscal deficit for the year if you go by these figures of just 2 months. After years of a slowdown in GDP growth and in tax collections, an upward swing in tax collections is always a sign of potential improvement in government finances. Though the question is whether such an increase in collections is just a temporary blip as we have often seen in the past, or whether rising tax collections will sustain themselves in the months to come, in the quarters and in the years to come. If India's tax collection for the June quarter has shown a bullish tone, then so is that of India's chief economic advisor when he talks about the emerging trends in the Indian economy. Speaking about the Indian economy on a recent occasion, he said that the Indian economy consolidated its recovery in financial year 22, with most constituents of the economy surpassing their pre-pandemic levels of activity. He said that continued expansion of economic activity is evident in the high frequency indicators that were recorded during the months of April and May 2022. He then says that the 22 budget started off with considerable degree of buffers through nominal growth assumptions as well as modest revenue assumptions and assumptions of tax buoyancy. It is quite possible, he says, that the nominal GDP growth turns out to be much higher than the growth rate of 11% which was budgeted in this year's budget. He estimates that on the basis of these figures, the growth rate for the year should perhaps be even better than what is expected. Further, despite the impact of the third COVID wave and the Ukraine war, growth at 4.1% in quarter 4 of last year indicates, according to him, that the growth momentum in the Indian economy is intact. He said that if you look at the April numbers of GST, etc., you will see that there is considerable momentum in economic activity. He ruled out any recession hitting India given its macro fundamentals. The CA then said that India is on a strong foot to tide over any external headwinds and to consolidate its growth story better than any other country. He pointed out that India has comfortable forex reserves to act as a cushion against external shocks. He further says that the Indian economy is better placed than other nations in order to avoid stagflation, which is a phase of low GDP growth, high inflation, and high joblessness, which we are actually already seeing. At this stage, he says we are barely 2 months into the financial year. Any attempt to estimate what the fiscal deficit would be will be highly speculative according to him. But he says that there is a very good chance that the final number would end up closer to what we expect for the financial year 2023 as per the budget. India's chief economic advisor finally said that balancing growth, inflation, fiscal and current deficits, and the external value of the rupee will be the continuous policy focus for this financial year, which is balancing growth, maintaining inflation, containing it rather, fiscal and current deficits to be controlled, and managing the external value of the rupee. This will be the focus of policy according to him. The CA in his analysis of the Indian economy, while admitting that it is too early in the day to project the overall state of the Indian economy for the current financial year, yet on the basis of the GST data, tax collection data, and various high frequency indicators for the months of April and May 2022, is upbeat about the growth prospects of the Indian economy during the current financial year, which he says could equal or maybe even surpass the budget growth estimates. He also thinks that the macro fundamentals of the Indian economy are strong. In doing so, according to us, he ignores the fact that it is due to uncertain and unsustained quarter-to-quarter growth. It is because of uncontrolled inflation. It is because of falling forex reserves being down to 10 months of imports from the earlier level of 15 months of imports. It is because of weakening rupee. It is because of a rising current account deficit. It is because of a burgeoning fiscal deficit. It is because of skittish consumer demand, etc., that many agencies, including the Reserve Bank of India, have pruned India's growth estimates for the current financial year. That too with a downward bias, indicating that it could be cut even further. The CA's upbeat analysis about the state of the economy belies to us the ground reality, as is very evident. So, what is the ground reality that we talk about? A reality check about the present and the emerging state of the Indian economy during the current financial year comes from the government itself, which admits that India is staring at a twin deficit problem, which is fiscal deficit and also current account deficit. Both of them are expected to rise. The finance minister cautioned the re-emergence of the twin deficit problem in the economy with higher commodity prices and rising subsidy burden leading to an increase in both fiscal deficit and also current account deficit. The finance ministry said in its latest monthly economic review that as government revenues take a hit following cuts in excise duty on diesel and petrol, the upside risk of the budgeted gross fiscal deficit has certainly emerged. In other words, the government receipts will fall shorter than the budgeted receipts, thus impacting the state of the government finances. It then says that an increase in fiscal deficit may cause the current account deficit to widen, compounding the effects of costlier imports, and it will weaken the value of the rupee, thereby further aggravating external imbalances, creating risks of a cycle of wider deficits and a weaker currency. And you will notice the rupee has already depreciated further. The report of the finance ministry then says that rationalizing non-capex expenditure has thus become critical, not only for protecting growth supportive capex, but also for avoiding fiscal slippages during the current financial year. The reasons that it points out to the rise in fiscal deficit include the possibility of fertilizer subsidy bill in the current year going up to rupees 2.5 lakh crores as against the budgeted estimate of 1.05 lakh crores. It will go up because of the Ukraine war. It will go up because of the food subsidy outlay is expected to touch 2.87 lakh crore rupees as against the budget estimate of 2.07 lakh crore rupees. The fiscal deficit will go up because of a sacrifice of revenue of 85,000 crores due to the recent excise duty cuts on fuel and another rupees 15,000 crores being sacrificed because of cuts in customs duty on select items. It points out that the additional subsidy on cooking gas cylinders will mean another expenditure of over rupees 6,100 crores by the government over and above the budget estimates, thus implying very clearly that fiscal deficit is expected to shoot up. The report indicates that growth is likely to be sacrificed in the policy making this year by saying that the high wire balancing act between maintaining growth momentum, restraining inflation, keeping fiscal deficit within the budgetary target and ensuring gradual evolution of the exchange rate in line with the underlying external fundamentals of the economy is the challenge for policy making in this financial year, and successfully pulling it off, it says very clearly, will require prioritizing macroeconomic stability over near-term growth. In other words, growth is going to be sacrificed because of these pressures on the macro fundamentals of the economy. It candidly admitted that the monetary and fiscal policies can address inflation from the demand side only and that it cannot address the supply side issues of inflation like trade disruptions, export bans, surge in global commodity prices because of the Ukraine conflict, which are all presently responsible for the surge in inflation worldwide and in India also. It finally, however, said that even as the world is looking at a distinct possibility of stagflation, India is at a low risk of stagflation because of its prudent stabilization policies. It is good to see a candid admission of the state of the Indian economy coming from the government itself, which normally tends to present a rosy picture. A twin deficit problem, which is rising fiscal deficit because of government expenditure being much more than its receipts, and a rising current account deficit due to the value of our import being much more than the value of our exports, means that inflation will remain elevated during the current financial year. It means that the rupee will weaken further. It means that government borrowings will necessarily go up. It also means that interest rates will remain high. GDP growth will be muted. There will be pressures on India's credit rating, and the government will have little scope to further prune taxes and duties in the year going forward. That's a tough year in the offing for the government. It's a tough year also going to be for the corporates and for the consumers too, as the economy struggles to avoid a stagflation. The fact of the matter is, we are already witnessing a slowdown in the growth rates. We are also witnessing inflation remaining stubborn and elevated. And what we are also seeing is that job growth is not taking place. We think we are right at the brink of stagflation. According to some, we are already into it. This is Akhilesh Bhargava signing off till we meet again. Namaskar.